Okay, so with all the talk there's been in the news of quantitative easing 2, a lot of people are wondering maybe what bonds are actually all about. The Federal Reserve, for example, in the US, has committed to buy treasuries, so buy bonds issued by the US government. In the UK, the Bank of England did a similar thing with quantitative easing 1. But what are bonds? What are these IOUs being issued by the government, and how do they work? Well, let's take a look at some bond basics by looking at a particular bond. If you were to look up government bonds in the Companies and Markets section of the FT, towards the back, you would find something like this. So first of all, you'd have a word like treasury. That's actually just a name. Then you'd have a percentage. So it might say 5%. Then you'll find a date. So 2014. Doesn't have to be 2014, doesn't have to be 5%, but let's take those as examples. And then a price, £113, let's say. Normally just 113. So here's a government IOU issued by the UK government. Why? It needs to borrow. Just like you and I, or just like a company, the government gets income, tax for example, spends it on defence, schools, health services, all those kinds of good things, and if it spends more than it earns in income, it has to borrow the difference. So the government issues these IOUs, sometimes known in the UK as gilts. That's the collective term. Now, the actual specific name of this one is a treasury. That goes back in historic terms to the name of the part of the government that used to issue them. So the name simply tells you this is a government bond in the UK rather than, say, a Tesco bond or a BP bond. This is the coupon, and there's something about this coupon that is similar to virtually all other bonds, corporate and government. It's fixed. Now, not all bonds carry a fixed coupon. You can get things called floating rate bonds, but we'll leave those to one side for this video. So, fixed means what? It means you know that this bond pays exactly £5 as what's called a coupon. And it does so every year. So the government, or part of the government called the Debt Management Office, will make sure that the holder of this bond receives a coupon of £5. And the reason you know it's fixed is because every gilt issued by the government has what's called a nominal value. And usually that's £100. And the nominal value is not the market price, that's over here, but the nominal value tells you what you can expect to receive in coupon terms, and it also tells you how much the bond will be worth when the government buys it back from whoever's got it, in other words, pays off its loan, in 2014. And people worry about the nominal value of a gilt. They think, well, if the price is 113, what is the nominal value? Think of it like buying vegetables. If I go into a grocer and say I want a pound of carrots, it's a pound of carrots. It's a pound of carrots whether you're me, the grocer, or my next door neighbour. Or perhaps in Euro-friendly terms, I should say a kilo of carrots. The price is negotiable. The fact it's a kilo of carrots isn't, but the price is. Gilts work like that. The nominal value is £100 to everybody all the time. But the market price is whatever the market, buyers and sellers, say it's going to be, and it changes. So if a gilt has a nominal value, you can say the coupon is £5 fixed, and in 2014 I can expect £100 back from the government. This is the redemption or maturity date. Corporate bonds usually have one too, and that's simply the issuer, in this case the UK government, saying in 2014 we'll buy it back. So unlike a share issued by a company, this has a fixed buyback date from the issuer. And then over here we've got the current price. And that will change potentially every day, every hour, as people try and work out what this thing is worth and trade it accordingly. Okay, so there's a basic bond, and the nice thing is that these are features of both corporate bonds and government IOUs. A coupon, usually fixed, a maturity date, also usually fixed. And a price, that's definitely not fixed. I've just chosen 113 for my example. Why would you buy one? Reason number one, it's backed by a government with a high credit rating. So one reason to buy is you're probably not going to have to worry about bankruptcy or default. But that's not enough. What about the return? As an investor, I'm thinking, well, I don't need to buy one of these for 113. I could be buying shares, or I could be putting my money into a bank account. So how do I know? And the answer for an investor is yield, return. I want to know what return this thing offers so that I can go out and have a look and compare it to something like a share, or perhaps a bank account, or perhaps indeed another one of these. So let's take a look at 2 return calculations useful to investors. Okay, number 1 is what's known as a flat or income yield. Very simple calculation. Some investors buy for income. They just want to know what a £5 coupon means as a percentage of the current price today in return terms. So, some investors will just say, thank you Tim, give me the flat yield, often quoted as the FY in columns in the FT for example. And they'll say, right, if I take a £5 fixed coupon and divide by the current market price as a percentage, I know roughly what my annual income return is going to be. And here that's about 4.4%. So if you're purely buying for income, between now and 2014, you can expect a yield based on what you paid of around 4.4%. That sounds pretty good for something backed by the government. And it's almost too good, because I've forgotten something. The problem with flat yield calculations is they ignore this to some extent. They ignore the fact that if I pay 113 today and only get 100 back in 2014, I've lost £13. A second calculation builds that in. It says this is a bit unrealistic. So let's build in an adjustment for the difference between what I pay today and what I'll get back in 2014. Okay, the name of that calculation, it has several names. One of them is the yield to maturity. If you look that up in a sort of newspaper or something, you might see a column headed up YTM. It's also confusingly known as the gross, because it's before tax, redemption yield, or the GRY in brackets. So that gives you a clue, it's this second calculation, and in practice it's a bit fiddly. I'd have to get into the time value of money, recognising that a pound today is worth more than a pound next week and next year. So I'm going to do a very quick and dirty calculation. If you try this at home and then go to the FT, you won't get the same answer as the FT. And that's not a problem, because most people just look the number up. But let's have a quick go at what it means, and what does it tell me, and why is it not 4.4%? And here's the answer. Basically what it says is, actually Tim, what you need to do is recognise you're going to lose £13 over roughly 4 years, depending on exactly when the government planned to buy this thing back. So, back of an envelope calculation, bit rough and ready. If I were to take the £13 and divide it into 4 chunks, that's for the 4 years, I reckon I'm looking at basically a £3.25 capital loss every year. So I could say I'm going to lose around £3.25 on this thing every year. Bit rough and ready, but around £3.25. And to turn that into a yield to maturity, all I need to do is the following. What I could do is say, right, roughly speaking, I get a £5 coupon, I lose £3.25 as a sort of capital loss every year, and I want it as a yield, as a return on my original investment. So I could say the true yield to maturity, that's this thing, the YTM, is more like 1.5%. Which isn't much. In other words, factor in the income and the capital loss every year, and my total return for holding this thing until it matures in 2014, just 1.5%. And you might think, well, that's not much, it's rubbish. And indeed it is quite low, and actually the real yields to maturity on government bonds are low at the moment. US Treasuries, around 2% or something similar. So why are people buying them? The answer is security, safety. These are issued by government, so the one thing you do know is although the yield's low, the issue is not about to go bust. And actually quantitative easing too is designed to get people out of these things to some extent. The Fed wants to buy IOUs in the US, push people out of them and into other investments or into lending the money that's freed up elsewhere. So one of the aims of quantitative easing too is basically the Fed buying up US Treasuries from the people that hold them, the primary dealers, the banks and so on, so that those banks can take the money and stick it somewhere else. Perhaps into corporate bonds, perhaps into new loans to individuals and companies.